Hey Bob, hey Doug, Marilyn and Chris and Tom is back. Gabriel is back. Good to see everybody in the ready and excited for the second day. I know for me yesterday, just thinking about the day in the life exercise got me excited because I can only imagine what 6 to 12 months from now will look like, right? So who did the day in the life exercise yesterday? Just let us know in the chat if you did the day in the life exercise. I want to know who took action, who actually did the thing, right? I know we gave you that first assignment, and each day we're going to be building upon it. But I want to know in the chat who took action yesterday. All right. Hey, Doug, good to see you. Carl just popped in the room. Good to see you as well. And Marilyn, I already knew Marilyn did. She's an action taker. She was in here all day yesterday engaging the chat so well. So well. So listen, before we get started, I know you all went and did your assignment because you're awesome action takers. But number one, just a reminder before tonight, if you're in Zoom, go ahead and get your camera on. We'd love to interact with you and just make this the most powerful experience yet. And this week, we're going to try to interact with you as much as we can. So if you can have that camera on, that's only going to improve your experience. Number two, regardless if you are in Zoom, Facebook, YouTube, wherever you're tuning in from, go ahead and grab a pen and paper because today's going to be a little bit deeper than yesterday. Yesterday we set the foundation, we set the floor for what's about to come. And so really, now we're starting to get into the nitty gritty. Now we're starting to get our hands a little dirty, and you're going to want to have a pen and paper. So number one, you can write down all the gems that come your way. But number two, so that if you have questions later, VIP specifically, you can ask those questions during the Q&A portion. So with that being said, I'm going to go ahead and let Dave and Doc come up here. Dave and Doc can come up to the stage, and we are going to get started with day number 2.
All right. Hey guys.
Hey,
Hopefully
everybody.
everybody can see and hear me okay. It is so nice to be back. You can tell my voice is a little strained from cheering for the Buckeyes till about 2 in the morning last night with everything there in Atlanta, but hopped on early flight and got back this morning, and it's great to be back with you. So today we're gonna take the next step, right? So we've kind of started, we've set the stage. Now we're gonna start to get into the types of income and some of the strategies that you do for that type of income, and really go from there over the next few days. So by the end of the week, we'll be going kind of like Doc said, we kind of like this into that funnel down to the individual step by steps, right? So Doc's going to start out today. For the first half, I'm going to take the second half. So Doc, I'll turn the floor over to you. And gosh, I'm just excited. I know what you're going to present, so it's awesome.
One of the things that we have to figure out, guys, is that there are so many things that you've learned over the years that everybody learns from the same sources that it takes you a year or two or maybe even 5 or 10, and some people never even learn them, that they're wrong. And we all learn them from the same sources. And as I go through my presentation, what I want you to do is I want you to think about what I'm saying and see if it aligns with something that you're already using and something that you're already thinking about. Okay, so what I'm going to do is I'm going to go into share here. So I am going to share my screen, and I want you to guys to let me know if you can see my initial slide. Can you see my initial slide? Can you chat into the room and let me know that you can see the slide that says replace your income challenge? Okay, thank you, Marilyn. Okay, all right. Once again, we're not going to be giving any trade recommendations today. We're going to be just talking about general topics. Day 2, we're going to be chasing financial freedom today. Why are we all taking time out of our personal lives on a Tuesday evening? Why are we spending time away from our families? Well, we are all pursuing financial freedom. This is why we're trying to do what we're doing, right? Financial freedom is extremely important because it affects what we can and can't do today and into the future. The problem is that we can't get to financial freedom using yesterday's tools. And this is what everybody's pushing on you today, is using yesterday's tools. And you'll start to recognize them as I go through this. So once again, guys, you know me, I am a visual person. I've got to see things in a visual format. So I'm going to walk you through a little progression today. We're going to talk about growing the pile. I'm going to talk about today's current state of the problem. I'm going to talk about a solution for you. And then this acronym, which is called TOPIC, TOPIC, means the one person insurance company. We'll get into those details in a minute, and then we'll tie things together with assumptions before we hand it off to Dave. Everybody got that? Okay. So let's talk about growing the pile, first of all. What does that mean, growing the pile? The old paradigm of investing was to grow your pile of assets to the point where you could live off of the interest. So the old standard was build up $1 million worth of assets, and then you can safely live off of $50,000 a year in interest at 5% APR. That's the way things used to be run. This worked very well until the great financial crisis of 2008, when rates went to zero and they stayed there. They forced people out of being savers. And then there's this whole generation of retirees that had no idea what to do. All of a sudden, they're basically earning 0%. In fact, in Europe, they went to negative interest rates because they wanted to punish people for saving money. They wanted it to be pushed back into rotation. They wanted that velocity. So all of a sudden, retirees had to start pulling directly from their principal. They had no way of making money from their money. And to some degree, this problem is even worse today due to inflation. So let's go into today's problem a little bit. Is everybody, can anybody relate to this, what I'm talking about? Has anybody faced the same problem that I'm talking about here? Can we all agree that this is a huge problem today? Okay, so the rates are not, I pulled this up this morning as of January 21st. I went in and searched on high yield interest rates, and it's all of 3.8 to 3.9%. Rates are not zero anymore. However, today's high yield savings rates are still exceptionally low, even with the Fed's funds rate at 4.5%. Earning 3.9% on top of a 2.9% annual inflation rate means that your purchasing power is barely keeping up. So this is on top of the 25% inflation premium that we've seen added the past 4 years. You guys remember the Inflation Reduction Act, which added inflation, ironically. So inflation premiums are sticky and they rarely recede. How often have you seen prices go down on things? So once people raise prices, it's that hysteresis. It's very difficult to get it to go back down again. And we see this even in the gas station, right? It's easy to go up. It's very difficult for it to go back down again. So how are today's fee-based financial advisors, you know, the ones that you watch on TV and you see ads for all the time, your fiduciary client advisors, how are they solving this problem for you? Well, there's usually 3 tools that they're using. Number 1 is annuities. They lock you in for years to receive a small rate. Or there's bond yields, basically paying about 4 to 5% on T-bills, or maybe a little bit higher for more risk. But again, you're being locked in. And then there's stock dividends, which can be upwards of 7%. But if you're getting a really decent dividend, that also means the stock is usually terrible. It's got a terrible chart, and forget about getting any kind of capital gains on that stock. So in the end, you get a more complicated solution using yesterday's solutions that doesn't really outperform high yield interest anyway. Yet they force you to tie up your assets and they charge fees and penalties for withdrawal. This sounds like a great solution for them and a lousy solution for you, the retiree or the investor. You guys with me? This is a problem today. And you still haven't solved the root issue of creating financial freedom for yourself. And this means that most retirees will be shredding through their principal in no time as expenses increase, wondering what happened, how they got it wrong, even though this has been in motion for 2 decades. This is a huge problem, guys, is that you guys are at the tip of the spear. You guys are at the edge of where things are at, right? You're right on the bleeding edge of where financial solutions are. But you got to understand that 95% of the people that are out there have no clue that this is even happening. They're going to look up one day and say, what happened? What happened to my retirement savings? Why did it all go away? So let's talk about the solution. The solution is we need to find a way to augment our income, or to find a more efficient way to generate income from our assets versus that yesterday's solutions, right? So first, a word about income. Let's talk about income for a minute. There's 2 different types, active and passive income. Active income requires participation to where we trade our time and expertise in exchange for money. Unfortunately, this is what a lot of people are doing. When they start to realize that they're bleeding their principal, they say, oh no, I've got to go get a job, because that's the only way that they know of to create active income. So welcome to your new role as the Walmart greeter. Passive income is an ideal way to create or augment income, as it does not require active participation. Your money is literally making money while you sleep. So this is ideal, but it comes with its own challenges. So the usual solutions that create passive income are interest and annuities and bonds and dividends. And these are usually insufficient unless you have an enormous asset base. Now, there's other ways to generate passive income as well, but they usually require specialized knowledge about real estate, right? So are you going to be a real estate investor? Are you going to tie up all that money? Are you going to become a landlord and have to deal with somebody calling you up at 2 o'clock in the morning, talking about a broken water heater? Or maybe assuming control of a business, do you know how to run a car wash, for example, or a storage facility? All of a sudden, it becomes another job, right? You're trying to get away from having a job by getting into a business, and then you find out it requires a lot of effort. So what's my solution to this dilemma? What are we going to do here? We're going to show you how to create active and passive income by creating the one-person insurance company. So there we go. TOPIC, the one-person insurance company. Think about what an insurance company does for a second. A lot of people don't even think about what they do, but it's basically, in a way, it's legalized risk management. In exchange for taking risk off of people's hands, they earn a consistent monthly premium. You pay them every month for auto insurance and home insurance, and basically what they're doing is they're taking risk off of your hands, and you're buying that peace of mind by mailing them a check every month. This is one of the most conservative, long-lasting business models out there. I mean, if I were to ask you, like, okay, rate the top 10 most conservative businesses that are out there, insurance companies would probably be up near the top of the top 10. You can run this business by yourself with very little startup cost. This is the biggest about running this insurance company through the market. All of the work, all of the infrastructure is already out there for us. We don't have to create a market to do this. We don't have to sell people on doing this. The market is already there for us. So it couldn't be simpler in terms of startup costs. So we can use this one-person insurance company to create active income, to create passive income. That's what the rest of this week is going to be about, guys. This is what we do every single day in my live trading room. This is what we do through the newsletters that Dave runs and the services that we do. This is what we do. We run basically a one-person insurance company and let you look over our shoulder on what we do. We create active and passive income. You can run it when you want to. You can shutter it when you travel. Dave and I can probably go into a lot of war stories about every time we travel, the market goes nuts. So we've learned not to do that. You can make as little or as much as you want based on how much you want to risk. You manage the limits. You don't have anybody telling you what you can and can't do within reason. So let's make some assumptions here before we start to drill into the details. We're going to use index and equity options on the US markets to create this insurance company arbitrage. We're going to be selling options. That's what creates the income. So we sell the position to open. When we sell a position to open, when we sell that asset to open, the cash goes directly into our account. We can do whatever we want to with it as long as we maintain the margin. We can spend it on anything we want to. We can use a portion of that for also buying options to reinsure our own positions to limit the risk. So at no point do we have to do unlimited risk or anything that's going to, take the house from us. So imagine the market. This is the analogy I like to use. It's like the stock market is this huge river of risk flowing by every second. Now, we're not suggesting damming up the river and blocking it. We're not going to block all the risk from the market. It's too big. It's trillions and trillions, it's dozens of trillions of dollars of wealth flowing by every second. All we're going to do is we're going to take a little bucket and we're going to take some of that risk out. And we get paid for it. Now we need to manage that. That's our job, is when we take the risk out of this river, out of this market, we're going to manage that risk, and we want to control how we manage that risk. We're going to siphon some of that off, and that's how we get paid. We're also going to stratify our risk by using more of our capital on the more conservative strategies, while only using a small amount of capital on the more aggressive strategies. So we're not going to go all in. We're not going to do a Wall Street bets thing where we're going to show you loss porn and things like that, right? Our capital is our lifebloods. We want to make sure that we manage it really, really effectively. The idea is that the more aggressive strategies offer better returns, but also they have higher risks. So we may have a lower win rate versus the more conservative strategies. So we need to use less capital for these. So one of the things that I've done over the years is I've always liked to have kind of a visual for things. And this is what I call the income pyramid. So first of all, with the lowest, the biggest area down here, the foundation, we start off with a foundation. When we build a house, we dig a footer, right? We put a foundation in, we don't start with the second floor and wonder why it slams to the ground. So we always start with a foundation, and this is what we're going to be talking to you about through Dave's session today, and then tomorrow we're going to go into great detail on the wheel strategy. The wheel strategy is what we use the most capital for. The trade durations are usually pretty slow. And what we like about these is that really once you set them up, you define your parameters, you leave it alone. You really don't have to do anything to it unless the price starts to go heavily in one direction or the other. And then we know exactly what to do when that occurs. But this is what I love about these strategies, is that they're really good for 2 to 5% per month on your employed capital, which is not a bad return. That's not a bad return at all. I mean, if you extrapolate that out, you're talking about, perhaps 20% return on your invested capital. So you're not going to use your entire account for this. You're going to use a good chunk of it, but you're not going to use your entire account for this. So further up, what we're going to do is we're going to stratify the risk. We're going to go into a strategy like iron condors. When it makes sense to do so, when we see range-bound markets, we want to take advantage of that with a range-bound strategy. We're going to use a little bit less capital for this. And we're going to seek a little bit better return, maybe 5 to 10% on this capital. And again, these are passive income. This is literally making money on your money. You're not doing anything with these. You're generally holding them for a number of weeks. Sometimes we could hold them for less than that if we want a quicker trade. But these are generally really, really passive trades where we don't have to do much of anything. Now, once we get past that area, once we get into the directional trades, now we're getting into active strategies where you have to manage this a little bit more. But even the swing trades, like I just closed out a swing trade today for 30% of capital. And it was, I really didn't have to do anything with it because I set the risk from day one for what I was willing to spend on it. And that was my risk. What I paid into the trade is what my risk was. So I didn't have to sit there and manage it every second and watch every single tick. So directional swing trades, when we see the signals show up, so think of us as a sniper, right? We're just sitting there with the ghillie suit on, waiting in the blind, waiting for the quarry to wander in front of our sights, and then we pull the trigger. And then lastly, we have, this is what we're going to be talking about maybe on Friday. And these are the intraday strategies. These are definitely active strategies where they must be watched, maintained, and managed. It's kind of like watching a child. You don't want to let it out of your sight. But you have the highest reward to risk on trades like this. So these are where you can make a lot of money in a short period of time. And it's very attractive to a lot of people. However, what I would always say is I want you to earn the right to get up to the next level. I want you to start down here. These are the easiest trades to manage, and these require a little bit more skill, and then these require the most skill when you get up to this point. So there's a progression. What I don't want you to do is to say, well, I want to go straight to here. That's like saying, I picked up a baseball bat yesterday, and I think I know how to swing it, and I want to go up against some major league pitching today. I think I'm ready for it. Probably not. You have to earn the right to get your way up the pyramid. So as you build more capital, then you can automatically do that. So that's the visual I want you to kind of anchor around. Okay, so now I'm going to flip it over to Dave to show you how we earn active and passive income via this income pyramid. Okay, Dave, off to you. I'm gonna
Yeah, before we jump in, just real quick, show of hands, or you can react in the chat. Does this make sense? Does the insurance concept make sense? Does the fact that you're selling that premium, you're collecting your job is to keep it, does that all make sense? And then I'm going to get in the pyramid a little bit more, but does it kind of hit home? Because it's antithetical to everything else that's out there. It's all about find the home run, right? We're not about home runs. We're about base hits that add up to home run like returns. And we can do that through selling, right? That's why insurance companies are the richest companies in the world. That little $150 premium they collect a month adds up over time, right? Across a lot of different people. So good. All right, so let me pull up mine. We're going to get into a few things today. So let's see here. Can everybody see my screen okay? You can just drop that in the chat. And again, I apologize for my voice. I've got my tea over here. I'll do the best I can to keep it. All right. So let's jump into this. So active and passive strategies. Doc kind of went through some of that on the pyramid with you, which I'm going to go into a little bit more in depth. I'm going to show you some actual examples, real world right now on the options chains. And so I think the first thing though that we have to really think about, and this is what I want you to think about, is what are we really referring to when we say active versus passive? And see the question on the screen says, are you an active or a passive trader? And so, do you want to, the question really becomes like, do you want to be trading every day on a weekly basis, throughout the month, or you just want to do a few trades a month and make your money, right? So for some people, right, you can trade once a week or just a couple of times per month to reach your goals, right? And create that income that you want or that supplemental income that you want. For example, maybe a 15 to 20% return on risk, throughout the year with just a few trades a month. Others are more aggressive, right? They want to trade more often because they like it. They're looking for or potentially to get a higher return, turn their money over faster. We call it velocity of money, right? Maybe they want to try to go after a 40 or 50% return. And yes, this is doable. The thing that you need to decide though, and you're going to need to decide over the next couple of days, is like, what type of trader are you? And the reason being is if you try to do everything we're going to show you, you become a jack of all trades and a master of none. You need to kind of figure out what your lane is, focus on that lane, get really good there, and then you can start to branch out, right? So are you someone that maybe values your time and more and wants to just make money with a few trades and then go enjoy life the way you want and that sort of thing? Are you somebody that is looking at trading more like a business? Like, maybe you're someone who's like, I want to do this for a living. I'm, 38 years old and that's what I want to do. And I don't want to be in the rat race at a job. And this is what I want to do. That's what Doc did, right? And went full time, right? So you kind of have to make that decision because it's going to determine, how you approach this, right? And some of this may depend on your capital. It may depend on how much, time you have to work and do this stuff. Because, for example, somebody who's 55 years old and has 20,000 to invest, and try to create income with, most likely you're going to need to trade more actively to have your money work more often for you, right? But conversely, if you're 55 years old and you got $1.5 million to invest with a goal of maybe making 10,000 a month, which is really an 8% return, you could do that with the wheel on just 1 to 2 trades each month. In fact, I recently met with one of our mastermind members and had almost that conversation. The student has over 1 million in investable assets and wants to make 15% a year. And in less than 40 minutes, we came up with a plan using the wheel strategy, stocks like Tesla, MicroStrategy, even the indexes like SPY, that they could literally reach their goal trading once every 6 months, literally selling a 6 month option out. And then 6 months later, when that expires, selling it again, right? Using the version of the wheel strategy that I teach and that we're going to go in depth on tomorrow. You can do that, right? So, and without very, very little, if to no risk, almost eliminated with the way that we do it. So imagine that. Imagine trading just once every 6 months to reach your goals. This is very easy to do, but it is the hardest thing for a trader to do because of that urge to trade. You guys know what I'm talking about, right? You guys ever been sitting there and maybe you don't have the setups that you are trying to get, and that edge isn't there, but you got money sitting there and you've got that urge to trade, right? You just like, I gotta do something. And that's what I looked at the student and I said, look, before you move forward, I want you to ask yourself if you can truly just follow this plan and walk away for 6 months at a time. Because if you don't have that discipline and you start like tinkering around, you can make mistakes and you're not going to hit the goal. Discipline is probably the most important skill a trader can have. Discipline to your strategy and your rules, discipline to trade only when the setups are there and hits, the discipline to, really let your trades work for you. So I want you guys, this is part of your homework. Start thinking about what type of trader you gravitate to, more of that active or passive. Um, and just to kind of level set before we, kind of jump into, some of these specific trades and going a little bit more in depth on them and the options chains. I just want to reiterate why we sell options. Doc talked a little bit about it, right? When we sell, we get paid up front to take on risk. That is a key thing, right? But at the same time, right, we also start out with the odds in our favor for what I talked about yesterday that you guys saw, right? And obviously, strategies are going to vary, based upon how aggressive you are and what you want to do. But the principle of collecting that money, right, from option or from buyers who are betting on certain price movements, it immediately puts that 67% odds in your favor, and that's a core thing to having an edge, right? And so, really, the trick for us as sellers is to capture theta decay, which is really, I'm not going to go into the Greeks with you guys and all that stuff and bore you, but it's just time value erosion, right? So every day that the option or the stock price or the underlying price is not at the option strikes price, right? Time's eating away at that value, right? That's like that insurance company. Every month you pay your premium, you don't use it. Well, the insurance company keeps it. Well, it's the same thing with the option, right? So putting that to your favor is another thing that helps to boost those odds, right? And so when we go to the income pyramid again, I'll pull it up. I'm not going to annotate like Doc did, but it's a great visual because it's how you manage risk and allocate the capital, right? The further you go up the pyramid, right, the more risk you're taking on and the less capital you should allocate to that risk, right? Base of the pyramid's the wheel, as Doc said. Now, some of you probably have heard of the wheel before, right? But maybe not the way that we'll teach it to you. If done right, it is one of the safest and easiest income strategies in the markets. And that's why we allocate, the highest amount of capital to it. But next up are iron condors. Now, iron condors are one of the best ways to create income, balancing capital and risk. But they do require a little bit different skill set. They require a little bit more skill to defend and manage if they do get attacked, right? When you play both sides, you have a chance, right, of getting attacked, right? So you have to know what to do if that happens, right? They can also be used, for, long, short term and everything too, right? Which is kind of nice about them. And they require less capital to do than like, say, the wheel strategy, right? Um, there's some great strategies that we love to do for this, right? But like I said, it takes a little more time, energy, and skill set around that. And we're going to go through that over the next couple of days. Now, like I said, don't worry if some of this goes over your head at this point, right? We're gonna literally go step by step on this stuff over the next couple of days. But I think the important takeaway is that you want to balance your capital and your risk, and the pyramid is the way to do it, right? So this eliminates the risk and issues of just banking on only one strategy for income. I used to do that. I used to just do one strategy for income, and when it's not working, you're not making money. And if it goes against you, you're losing money, right? So it's nice to be able to balance with multiple strategies and be able to deploy them in the type of markets that you have. All right, so let's jump into passive income strategies, right? So passive income strategies, level one of the pyramid, less frequently traded, right? Maybe once a week, once a month, longer dated options, 30, 60 or longer to days to expiration. They have a lot reduced management, more set it and forget it style. And obviously the wheel is the place for that, right? So the passive approach may only be placing trades once a week or even just once a month, right? Often longer dated options. Now, with options, the further you go out, the more premium there is, right? Because there's more of a chance that the stock could be, or the underlying price could be at whatever you sold at. That's why they pay more, right? And there's more time, right? But as time goes, the option loses its value, right? That decay comes in, right? And so those are when you think about a passive strategy, right? You have to do a little bit of action to get it, but it's, less than 12 minutes, right? So that's the whole point. Now, more active strategies, right? That's that level two and above on the pyramid. Weekly, monthly iron condor selling, focus typically on like indexes are best. Individual stocks are tough because you are at the whim of news events, earnings, all that type of stuff can come into play and, mess with the stock. In fact, if you had sold an iron condor on Netflix, Netflix is up 12% or so, or at least it was after hours, that might have run through your top set of strikes, right? So it's a lot easier to deal with on the indexes. So we like the SPX, the NDX, and the RUT the most because those are European style options, which means they're cash settled at expiration. They're not American style, which can be assigned. So, maybe you fall asleep at the wheel a little bit and all of a sudden, the price is in one of your strikes, right? In an American style option, you can be automatically called to that anytime, right? The SPY, the IWM, the QQQ are American style, but those are obviously kind of derivations of the SPX, the NDX, the RUT. Shorter time frames, typically 1 to 4 weeks on these, more frequent monitoring for adjustments. All right, so an example of that active strategy, right, is selling those monthly iron condors or index options, right? So you might open a position on Monday and aim to close it by Friday, collecting premium if the index like stays in a certain range. But you'll be checking those positions more frequently, typically daily, every other day, right? You're ready to adjust if the market moves your way, and this can be more engaging and often, more lucrative when done properly because you can turn that capital over faster and it requires less capital to do it. Oh, I missed one, guys. Hold on a second. Where'd it go? Where's my thing? Well, I'll get to it in a second. So for the wheel strategy, though, I'm going to jump in an options chain for this. What happened to my slide? Disappeared. There was one with a wheel on it, guys. All right, we'll go back to it. All right, so here's the thing I want to talk about with the wheel that I really want you guys to understand. And here's how I look at the wheel. I'm going to bring up the options chains for an index and talk about it. So the wheel strategy, and everybody can see this, right? Yeah, you guys got it. All right. So the wheel strategy I liken to real estate. This is going to sound a little weird, right? But if anybody, just think this through. If you were going to go buy a property in real estate, let's say that you were going to buy, I don't know, $100,000 property, right? You would typically go that property be listed for 100,000. You might lowball a little bit, right? Say, hey, 95,000 is my offer on the property. And you'll probably haggle a little bit with the buyer and stuff. Maybe you end at 97, 98 to buy the property, right? And you've got a deal, right? That's your deal. Well, the wheel strategy starts with what's called the naked put, right? Which is selling a put option. And the way that I liken that is if you were to go buy that same piece of real estate, right? So let's say you were going to go to that $100,000 property owner and you said to him, I really like your property, but I want to buy it for 20% less for $80,000. And what would be great is if you'd pay me $2,000 to buy it from you for $80,000, 20% less than you're offering it. How many think that they would take that deal? How many think that that they'd be like, yes, I want to let it go for 20% less, and I want to pay you $2,000 to take it from me at that price? Nobody would do that. They would laugh you out of the room. It would be like a joke to them, right? Well, guess what? A naked put, you can do exactly that. A naked put, you can go out any stock, you can go as far as you want, from where the price is, and there's an option strike price for it, and you can sell that, and you can get paid to do that. Now, if you go too far, maybe it's pennies, right? Not worth it for maybe you. But guess what? Like Goldman Sachs and all these guys are doing and stuff with this money. How do you think they're making money in their trade desk? These guys are moving massive amounts of options, picking up a penny, 2 pennies, 5 cents, selling these things so far to the money that they have a 99.99% chance of winning on. And they just collect it over and over again because they have massive amounts of money to move, right? So the wheel starts by selling a naked put. So what I have on the screen is I have the options chain on Soxal. So everybody here has heard of NVDA, right? NVDA, the chip makers, is the hottest stock, blah, 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 right? Well, Soxal is basically a semiconductor ETF. It tracks the different stocks in the semiconductor index, NVIDIA being one of them. And so it's a hot area of the market. It's a trending area of the market, right? It's got a lot of run room for years to come, right? So this is a nice just index that tracks that sector of the market. And so wouldn't it be nice to be able to trade this sector of the market, not have to rely on any one stock, say just on NVIDIA, right? Or any, one single stock. Wouldn't it be nice to just say, hey, I'd like to own this sector of the market, but I want to own it less expensively. I want to get paid to do it, right? Because maybe this stock, maybe this sector or, this index will come down a little bit. I don't want to be buying it at the price that it is today. Well, you can see I've come down here and I've highlighted the 28 strike. So that if you do the math, 34 minus 28 is about $7. So that's close to about 20% below where it is now. So that means the sector has to drop 20% for this thing to get down there. Okay. And you'll see if I go out 60 days, right, to March 21, that's 59 days, it's selling for about $2. So now if you do the math on that, options trade in 100 share blocks. And so that means I make $20 for every contract that I sell. So if I was to do this and sell 10 contracts at 28, I would sell, this is Thinkorswim for you guys that use trading platforms. If you don't Thinkorswim, we do highly recommend. But I would sell single. It's going to pull it up, right? It's going to show it to me right here. So put it at the highest price, $1.96. If I hit confirm and send, if I had $26,000 that I wanted to invest in this, I'd make $2,000. You guys do the math. It's about 7 to 8% return in 60 days. And I'm saying, hey, I'll take this when it's 20% lower for that price. Pay me to do that. I'd love it, right? Now here's the kicker. If that price, okay, of the underlying on March 21st is not at 28, let's say it's at $28.32. You don't have to do anything. You get to keep the money that you were paid, and you can turn around and do it again and just over and over again, right? So that's how the wheel works. So the first beginning of the wheel strategy is I want to sell options to get put to stock. So you want to do this on stocks that you like or that you potentially want to own. So part of your homework is to start looking at and putting together your list of stocks for the wheel strategy. So take that down because we're going to start asking you guys about some of these tickers when we jump into this because we're going to analyze them with our methodology and look and see if there's good opportunities with these over the next couple of days. So you want to start thinking about what stocks make the most sense for you, right? That you'd want to own. And you can start selling the put on them. Now, you can do this. I've done this. I've gone through, I think the most I've ever gone through in a stock is I've sold probably a put on it like 17 times before I actually had an assignment. By that point in time, I had made so much money on the stock that I literally had whittled my cost basis down to like $3 or $4 on the shares, and I think I got put it in the 30s. So that's kind of a nice thing. Eventually, you get to play with the house's money. But let's say it does come down here on March 21st, and it's at $27. Okay. So I gotta accept it because my obligation is, hey, I said I'd buy it at 28 if it's at, on March 21st, if it's there or below, right? So then I buy it. So now I've got the shares. Well, guess what? Now we do the opposite. Now we've got our market property, right? We've bought our property 20% below market. We've gotten paid to do that. Well, now what we do is we turn around and we collect rent on our property by going and selling what's called a covered call. So now I come over to this side and I can sell. Usually you want to sell about where you were put the stock, or within the range of like if you subtract your premium from, what you were put the stock at, what that price was. But you want to sell around there. And it's typically, going to be within right around where the money's at, probably if you're assigned. And so then you're going to collect rent and you'll keep selling the covered calls. Now you can go further out and you can say, hey, you know what? I want to sell at 40, right? I'll take $2 again. And if the stock runs up to 40, I get that appreciation plus I got paid again, right? And so it's just like playing both sides of the stock, making money off it no matter what it does. Okay? So you can always make money on it. Now, where's the real risk on a naked put? The real risk on a naked put is if this thing drops from, 33 or whatever it is to 18 or 19. Now you're in the hole, right? By more than what you got paid for it. Now you can turn around and sell calls on it. You may have to go for a few rounds of that, right? But you wanted to own it, right? So you can collect income off of it. There are ways to mitigate that. That's what we're going to show you tomorrow. But that's how the traditional wheel strategy works, right? Sell the put to get the shares at a lower price, turn around, sell covered calls to make money on it over and over and over again. I know that's a lot to take in. Do you kind of at least follow the principles of it? And you can put that in the chat just to make sure I want to gauge that you guys kind of get that. So I see some yeses. Yep, awesome. Thanks, Marilyn. Good, excellent. All right, so you're kind of seeing how this is, this is why this strategy is so popular because the worst that happens is you own the stock, right? That's the worst that happens, but it is more capital intensive, right? $26,000 for 10 contracts to make a couple grand, right? So, if you're like, the student I was mentioning earlier and you got, million plus, hey, that's a great trade. You got, you're not allocating too much of your capital in any one trade at that point. You can balance it and everything else, right? So there's a good opportunity for them. But let's say you're somebody that's got a $20,000 account. Like, how do you then make money with that? Well, that's where the Iron Condor level 2 comes into play, right? So what an Iron Condor is, I go out, let's say 30 days. Let's just go to here. An Iron Condor it's a put spread and a call spread. And I realize I'm getting into the weeds on this, but this is a primer for tomorrow. So a put spread is where you limit your potential loss. So with a put spread, I actually am selling a put, but I'm buying a put at the same time. So let me show you what that looks like. Let's just go to 28 right here, right? A month out, and I'll do a sell vertical in Thinkorswim is what it's called. And I'm going to do, I don't know, a 3 wide spread. Well, you can see it's paying 52 cents. Okay. That's $52 per contract that I do, right? My risk is $3 because I'm basically limiting it between 28 and 25. So if I hit confirmed here, you would see I'd make $510 on just 2,400. The difference in the amount of return you can make by doing the spread versus, maybe a traditional sell to put, right? And that's why these are very, very attractive to traders. Where traders get in trouble with these is they start doing a lot of these. They ratchet up because they've got more, they don't lose as much capital, right? And so they'll do 20 contracts, 30 contracts, right? And it'll work for a little bit, but then all of a sudden, guess what? That stock does drop 20%. Now, all of these options at that 28 by 25, all of a sudden, you're in the hole on that. And it's not as easy as just getting put the stock at that point because you've probably sold way more contracts than you got money for in your account to take and get put the stock. So you got to exit. So where it was 52 cents, maybe it's now $2.80 to buy it back to exit it. So you've lost 5 times what you effectively got for the trade in the first place, right? So that's why these have more risk because you have to understand how to manage them. Now, one of the things I'm going to advocate and we're going to show you as a base way to do this is what's called static risk, right? But you can roll these things, you can maneuver them out, move them up and down and all that stuff. It's just there's a lot more management and everything with that, right? But the iron condor is when you do a put spread and you do the same thing the top side on a call spread. So let's say I want to do, that 7 points out of the money. And then in Thinkorswim, they've got a nice feature where you can do it as an iron condor. So I can say, hey, I want to do a 3-wide spread, 28 by 25. And then I want to come up and do 40. I like that, maybe I like that 40 strike. So 40 by 43. Got to be the same width on both sides for the iron condor. Well, guess what the cool thing is? I've now doubled my income, right? I'm now making about $1. And the cool thing is when you do an iron condor, you'll notice the amount that my broker is setting aside, okay, that I could lose. This is my buying power effect. That's what I could lose, right? Is not doubling. Remember, it was a little over 2,000 on the put side. Well, what the broker does is it says, well, you can't lose on both sides on expiration day. So we're not going to set aside any more money. So that's why it's the iron condor is one of the best trades because you can literally double your profits with the same amount of money. The other thing about an iron condor is the best defense for the put side is the call side. The best defense for the call side is the put side because you can't lose on both sides, right? In expiration. So you get more money to work with. And what we typically do is we don't stay into the full expiration. I've got a target percentage that I want to make and then I get out. Target percentage I want to make, then I get out. And because you've sold both sides and increased your premium, it's a lot easier to do that. So that's a primer on kind of how these work, just so you kind of have an idea. But this is how you can create that money. And so, what I've done in this case or would have done is bracketed. And as long as this thing stays under 40 and above 28 for the next 3 to 4 weeks, and typically I'm actually in these things usually for only about 2 weeks, but when I do a 4-week trade, but as long as it does that, you win, right? So all you do is just say, hey, stay in this range. And we have ways of determining if a stock is going to really trend or not, or if it's more range bound. Just came out kind of a consolidation period for 3 or 4 weeks, right? That was in the markets as a whole was great for iron condors. They worked really well during that time. And so we have ways of looking at the market character to determine, hey, yeah, this chart, Soxel, really good time right now for iron condors. Or you know what? Really good time for selling puts and so on. You'll learn some of that over the next couple of days. So again, kind of a primer, just getting in, starting to show you a little bit about how these things work, just so you have an idea and a little bit more of an understanding of these different trades. So personally, I really like doing the wheel and like the 2 to 4 week iron condors. That's where I really like to play personally. I do the wheel, usually once a week, and then I trade my 2-week trades about 2 to 3 times a week, and then I trade my 4-week iron condors just once a week, every Friday. Do it in about 10, 12 minutes. And that's what I send my students, and obviously they follow in what we do and everything. But with that said, you want to look at the side-by-side comparison, right? Remember, you got to decide which type of trader that you want to be, where you're going to spend more of your time, active or passive, right? Because you have to have more focus when you're active for the reasons I just talked about, right? Passive, a lot less engagement, right? Often lower risk, not as much of an upside, right? But you have to decide which one makes sense for you. So I like to be, kind of not super active. Like Doc will be in and out in the day, right? And that stuff. I don't do that so much. I like to be, kind of mildly active and then do the wheel passively and put it together, right? So you want to start thinking about that for yourself. So key takeaways, right? Both methods can generate great consistent income. Passive is fewer trades, longer expirations, so your money's tied up longer, lower intensity, right? Active, more trades, shorter expirations, turn your money over faster, higher intensity. So you got to match your lifestyle, your time availability, your risk tolerance to that. So your homework again is to decide which type you gravitate to more, so you can focus on becoming really good at those strategies. And I also want you to come up again with that list of your stocks that you could use for the wheel. That's the base of the pyramid, right? So we always teach everybody this. And so you want to start looking at those kind of put option levels. Like where would you want to own that stock up, right? Where would you want to get it at? What's that option premium paying? Is it paying enough that it makes sense to do for you, right? So you want to look at that. And then tomorrow, we're really going to start the deep dive into the individual strategies, really walking you through step by steps on how to execute, defend, exit profitably so that we can, really help you understand the end to end. The exact same things we teach our students and trade live with them every week, we're going to walk you through. So rest up, get ready. I'll rest my voice and get it ready to go too. Because we're really digging into income trading in earnest tomorrow to create your own personal insurance company. So I'll stop there. Any questions that people have, we can jump in. And Mike, I'll turn it back over to you. It looks like you're on mute.
What about now? Can you hear me now? Can
Yep,
you hear
we
me
got
now? Awesome, awesome, awesome. All right, y'all. Well, listen, we're so excited. What do you guys think about day number 2? I apologize. I'm having some technical difficulties, y'all, today. I'm going to get this figured out tomorrow, so thanks for bearing with us. But what do you guys think about day number 2? Let us know in the chat what you thought. You learn anything new, let us know. I see Gabriel is here watching, Karen and Zoe. Good to see you all in the Facebook world. But listen, this session is only the beginning. And what I would love to do is invite you all to join in VIP to get this done faster and to get more clarity. So I know what we're going to be doing now. We're officially going to be closing out the main session. But Doc, I would love, and Dave, I would love to give them some homework and something to kind of be doing tonight. I don't know if you all have anything on your mind, something that they could be taking action on and just kind of applying. Do you have anything that they could be doing tonight to prepare for tomorrow?
You might have missed it a little bit with the technical difficulties, but I did give them some homework with the wheel strategy to start scouting those stocks, start looking at the option prices, where they may want to own that stock to sell out to get an idea of what type of returns they're getting. And then also really to start looking at and deciding, are you more passive? Are you more active? You can do both. I do both. But which one do you gravitate to more? Because again, it's best to really learn one, get good at it, then you move to the next ones. Remember, these are skills you're learning that you can use the rest of your life and pass on for generations, right? So it's important that we figure that out. It makes it even easier. And it's what's great about what we do and what we'll teach you guys and what we like do in our services. We have something for everybody, right? We trade across all these every week, right? So you're gonna get in, but it's okay just to kind of gravitate towards that one. Figure out what that is for you, and don't worry if you don't understand. Like even some of the things that I just went through. Okay, anything can be learned. Something I was told when I was very, early in my career, and it's always stuck with me. Anything can be learned. It's just whether you want to apply yourself to learn it or not. If I want to become a rocket scientist, if I'm willing to work hard enough at figuring out how to do it to become a rocket scientist, I can do that. I don't want to do that, so I'm not going to be a rocket scientist. But if you want it bad enough and you want to understand and learn it bad enough, you'll do it, right? That's human nature. And so, figure out what that is for you and then just go all in, with it. And hopefully everything it'll help you do that really fast, right? Over the next few weeks, you can start maybe executing a trade or two. And so that's my advice. You know, don't just take information without action. It does you no good, right? So make sure that you make that commitment to yourself that you're going to take it, you're going to start putting it to work, and really make a difference in your life.
Thank you so much.
Something
Thank you.
else that you can do as we go through this challenge is identify strategies and trades that really sort of speak to you and that make sense to you and say, wow, that looks really cool. I'm excited by that. Because remember what I talked about yesterday when I said, find your one thing. Find your one thing. And find that strategy that gives you the rage to master it. If you've ever been involved with something where you just go so deep and you just go insane and there is no time, right? Everything passes so quickly because you're just so focused on it. That's what you've got to find. So as we go through these strategies, find something that really sings out to you and then make that your one thing.
Thank you so much. I must have missed that with the tech difficulties, so I appreciate you guys. Thank you, Dave. Thank you, Doc, for squaring that up. So you all go take action. We're so excited that you are here for day 2. Tomorrow, we're going to be here for the same time, same places for day number 3. Don't want to miss it, but I'll say if you want to come and get clarity, if you want to come into the Zoom room for our exclusive Q&A that we're about to step into right now, the team's going to drop a link in the Facebook stream and the YouTube stream for you to upgrade to VIP. It's only $97. You get access to Q&A all week. You get access to another course you can watch in conjunction with this class. That's phenomenal, and there's a lot more inside VIP that you can gain access to. We actually gave a PDF earlier this week to all the VIP, plus you get access to the replays for an extended time. So if you want that, the link is in the chat. The team just dropped it, and I just pinned it to the YouTube feed and the Facebook feed for you all to jump in and take action on. So you guys can jump into VIP right now and come and get your questions answered. Because I know, Karen, I know you said I'm in New Zealand. I believe you said New Zealand. Are these sessions going to work for me as I'm not in the U.S. exchanges? So that would be a perfect question for VIP. I'll let Dave go ahead. Dave, you care to go ahead and just answer one question for Karen? Is that okay?
Yeah, it's fine. I actually just got back from your wonderful country. I was in Taupo competing in the Ironman championships that they had there. So we started in South Island at Bluff and went all the way up through the whole country. So just an amazing place. And if anybody that is watching this ever has the chance to get out there and visit New Zealand, you should. But to answer your question it will depend some on the exchanges that you trade, right? Because you're roughly 18 hours ahead, right, of the U.S. market. So you're probably more trading the Australian market, probably. I don't know much about the New Zealand market, but I know the Australian market, really the kind of the third largest behind the U.S. You can do these strategies there. It does depend on the broker. Some of them you can do, not all of them you can do. So it's best to investigate with a broker. So one of the things that I would say homework for you as we start to unpack these strategies for you over the next few days, right? Take note of them, talk to the brokers and say, hey, can I sell naked puts? What do I need to be able to do that? Can I sell covered calls? And that would be cash secured naked puts too. And because again, you're setting aside the money to buy the stock and doing that, right? Can I sell covered calls, right? Those are some basic options trades that you should be able to do on most platforms over there. That's what you need for the wheel. As you get into condors and vertical spreads and things like that, they may have some limitations on that. So it will depend on your broker. So that's the best thing to do is start to investigate a little bit. You maybe even call them tomorrow, or it's getting to be daytime now for you at some point, right? It's like in the afternoon or later afternoon, I think, if my timing's still right. Call them up if they're still open. Ask them, see what they say you can and cannot do.
Awesome, great feedback. And she said that I am also able to use Australia as well, so I'll do that. So awesome. So you all know the drill. Thank you, Karen, for the question. If you all want to go ahead and upgrade and be in VIP, the link is in the chat. Karen says it's actually 2 p.m. So Dave, you were right. So
there you go. It's afternoon, right? So there's time. You can still call the broker. Perfect.
awesome. So with that being said, we are going to close out the main session. VIP, hang tight in Zoom. We'll see everybody else tomorrow for day 3. Make sure you show up 7 p.m. Eastern Standard Time, and we'll see you soon. So VIP, now it's time. You can go ahead, use the hand raise feature at the bottom of your screen, or you can simply just throw your question in the chat if you have a question for Dave or Doc. But everybody else, we'll see you tomorrow.